Most of the investor, they have this mindset that the only goal has to be getting a good salary. Okay, but whether whatever they are earning, I mean, are they really creating a wealth, or they are just earning a handsome salary?
Wealth is not about how much you earn, right? It is about what you do with what you're earning. Right? You One of the biggest mistake which many individuals make is
We want to create wealth overnight, so there is this mindset amongst us also. So how do we deal with it?
everybody wants things in an instant, right? But unfortunately, you need to understand that this is not a game of.
We come across a lot of feeds through shorts or reels which keep on telling us about how to create the wealth. So even this at times is misleading. So
Yeah,
can you
yeah,
address that as well?
it's what we call it as the influencer risk. Influencers are basically trying to get sound bites for themselves. Everybody is trying to sell their sound bite. You have to take all this advice with a pinch.
Welcome to the investing mindset. Most people believe that building wealth is all about earning more money. But if that were true, every high income earner would be wealthy. So, what are the biggest mistakes that stop people from creating wealth? Let's discuss this with Juzer Gabajiwala, director at Ventura. Hi, Juzer.
Hello, Harshata.
Juzer, you have interacted with investors for more than 2 decades now. Do you notice a certain pattern or habits that repeatedly stop investors from creating wealth?
So I think more have been what I have learned myself during my own investing journey, and when I have also seen how people have behaved over so many years. I've been investing in the markets for now nearly more than 25 years, right? Seen lots of ups and downs, right? I think the most important thing is that investors do not lose money in the market; they actually lose it to themselves. Right? So if I have to actually create some buckets of mistakes which are made, so there are five most important buckets in which I would actually place these mistakes under, and it has got more to do with the behavior and less to do with actually the monetary aspect of it.
Having said that, most of the investor, they have this mindset that the only goal has to be getting a good salary. Okay, but whether whatever they are earning, okay, they are earning well, but whether they are doing a justice to it, I mean, are they really creating a wealth, or they are just earning a handsome salary? So how
So
you would put it?
yeah, so actually, what I would look at is that I actually call that as the incorrect mindset. So wealth is not about how much you earn, right? It is about what you do with what you're earning. Right? You One of the biggest mistake which many individuals make is that when they are earning, they are spending everything. They're not realizing that they also have a life post a particular age where you need to be financially independent and you will need to take care of yourself. So you need to start creating that habit, right? So when you look at it from a balance sheet perspective, you have income, you have expenses, you have assets, and you have liabilities, right? Income is what you're earning. Now it depends on how you're spending, right? I'll give you a very classic example of Boris Becker. He was a very famous tennis player, and as most of the sportsmen have it, they reach a peak at a particular age, and after that, they don't have anything much to be done, right? Now he had a very lavish lifestyle, and because of that, he actually went bankrupt, right? So if your expenses are equal to your income or more than that, you can suffer because of that. The other thing is that you create liabilities, right? Now, by creating a liability, it is at the other side you are actually looking at it that you are buying an asset, but that asset could actually be a depreciating asset or an appreciating asset. So even though let us say a car and a house, both are on the same pedestal, a car is a depreciating asset. So if you're, buying a vehicle, and your aspiration is to have a luxury car, hmm, and if you cannot afford it, so then that becomes a problem. You are buying a house and you are renting it. You are actually creating an income, right? So one is that whether you are creating a appreciating asset or a depreciating asset, and along with a depreciating asset you are also at times increasing your asset, right? So the same way as you are earning regularly, you are spending regularly, so are you investing regularly? So that is a very important question an individual needs to keep in mind, because when you are spending money, what happens at that point of time is that you get instant gratification because you are enjoying everything. But you are postponed your pain, right? When you are borrowing for a depreciating asset, again you are getting instant gratification, but what you have postponed is your anguish, because that is more painful, right? And if you are creating wealth for the future, then actually what you have done is that in the instant there is a little bit of discomfort, but and you have postponed your gratification, and it could be much much more, right? So this is one of the most important thing, and I think this is one mistake which most investors make, is that they will think that let me earn more, let me enjoy now, and then I will start my investing journey. So that is something which most of the investors will need to bear in mind. No? The next mistake which most of the people make is towards where you are impatient.
Right, right. Exactly. I was about to come towards that only because we have seen over a period so we have come across investors, those who invest for a year or two, and if the funds are not moving, then they get restless. So how to overcome this particular thing?
So that's the problem. Everybody wants to be rich, but nobody wants to give time to their investment, right? So most of the investors, you have there's a formula for return. How your compounded return is calculated. In that, one of the thing is the return, and the other is the time factor. Most of the people actually focus on the R, right? And they don't focus on the T, right? So they focus on the return and not on the time. Yeah? So let us take a classic example. Warren Buffett is known to be the father of investments, and he has done exceedingly well. And today, the amount of wealth which he has is actually a product of time. Okay, so he is nearly 95, 96 years old. He made his first million when he was 30. At the age of 60, I think he had somewhere around $17 billion, right? And today at 95 plus, he is worth more than $140 billion, right? So you can see how the power of compounding is, helping him. And he is Warren Buffett mainly because he had the time factor, with him, right? And he himself says that, that I am a product of compounding, right? And he started his investing at the age of 11, and he felt that he started too late, right? So this is something which now a question which you can ask is that, can you become Warren Buffett, right?
Right.
So I think it is possible, and I'll just share a small example with you. Let us say in 1995, right, which is exactly 30 years from now, maybe 96 or 95, right? uh, Mutual fund was not known much of a concept. huh? And supposing you are invested in this HDFC Flexi Cap fund, okay, no particular reason to choose that, but it is one of the oldest fund which has been there and fairly popular with a large AUM. And if you had invested 5 lakhs at that time, yeah, not a very large sum, not a very small sum, it was a reasonably good amount. 5 lakhs in 1995 still had a good value, right? I think you could have bought a property in somewhere, but in the suburbs, Borivali or something like that, right? Now, for 30 years, that is still now, that amount actually would have been nearly around 13 crores, right? So that's a fairly large amount. Now that's the reality. Now let us assume that the same money, if I don't do anything, I cut the noise and I hold for the next 30 years, then what will happen, right? And let us assume a very simple exercise for the benefit of everyone, that my money will double every 5 years. Doubling every 5 years means you're earning somewhere between 14 to 15% return. So this money will technically, you have 30 years more. So six times where it will double. This 13 crores will become nearly 800 crores plus, right? So by the time you touch 60, it is nearly 800 crores. Now, suppose you reach Warren Buffett's age, right? So we are talking of 35 odd more years. So if you touch over there, you are talking of somewhere, in excess of 1 lakh crore, right?
That's a huge.
So that is nothing but the power of compounding. You're focusing on the T, and not on the R. The mistake most investors make is that they focus on the R and they don't want to focus on the time part.
So now, since we were talking about being impatient, so there are investors, or many of us, we want to create wealth overnight. So there is this mindset amongst us also. So how do we deal with it?
Yeah, so I think that's the third mistake, which people make, that everybody is chasing quick returns, and now we are in a jet age, everybody wants things in an instant, right? To such an extent that even if you send a WhatsApp message to somebody, you want a reply instantly, and everybody wants even returns to be instant. But unfortunately, you need to understand that this is not a game of return. This is a investing is a game of long term. So you will need to look at investing from a long term perspective. If it was so easy to make money, everybody would be just focusing on the markets out here. In fact, it is very surprising that we find that today a lot of youngsters and many investors tend to focus on the futures and options. And in fact, there has also been a SEBI study now where we knew it for quite some time that trading doesn't make money. Some people do make money. It's not that everybody doesn't make money, but 91% of the people have lost money, and that is the SEBI study. That out of every 10 investors, 9 investors are actually losing out in terms of their investments. And I think last year itself, there is the wealth which was lost was around more than a lakh crore, right? So chasing that from a short term perspective is for long term wealth creation. You will have to chase returns which are reasonable. You cannot expect that you will become a millionaire or a billionaire overnight. It doesn't happen that way.
Right. So, like you are suggesting that to keep investing and trading separate, right? Because there are many investors, those who feel that investing and trading is almost the same. So, how do we differentiate it?
Yeah, so what happens is that, and it is human nature and human psychology that nobody talks about their losses. So everybody will talk about their gains which they have made, right? So a particular stock may have done well, and you will find everybody is talking about that. But here, the person will never talk about any place where he's made a loss, because nobody likes to, show that he has not done well. The reality is that you cannot look at it as a individual stock by stock transaction. You have to look at what you have done in the entire year as a portfolio, right? If as a portfolio, you are doing trading and you have not done well, and you find that the market has actually gone up, then there is something wrong at your end. So you need to be clear in terms of what you want to do, how much you want to do, and what is the uh, risk appetite which you want to follow, right? It is not that FNO is bad. It is there. It is a instrument which is used by many people. It depends upon how you are using it and how you are making money out of it and where you are drawing the line. So, like they say, there is no free lunch, and for everything you need to work hard.
Absolutely right. So, as an investor, I have felt that many a times you are on a right path, you are earning returns, but the moment you compare, you see someone going ahead of you or beating the returns that you are getting. So you get that it stings you that someone is earning. So whether I'm on a right path or not. So how do you address that?
Yeah, so it's a very good question, and that's how you have the saying which goes right. The grass is always green on the other side, right? So you always think that my neighbor is doing much better than me, and I don't know what he is doing, right? So I think you have to be very careful of the comparison trap, and that is what I call it. So we'll have to be satisfied with what you are making. I think that is the most important thing. And I have a very interesting story over here, because this is something which has actually happened with me. So and I have actually put up a post on LinkedIn also on that. Is that, I mean, as has been my nature, you tend to talk to your friends about how to invest, where to invest, what to do. So there are two friends whom I had suggested something to invest, and we were actually just meeting up one fine day. I think maybe it was after a year of the investment or something like that. And if I'm not mistaken, I think somewhere around 24 or something is when I would have met them. Now, the first person, when he came in first, now I was waiting out there, and he was extremely happy. Right? He was happy. He said that my fund has done very well. I got a 27% return, and the benchmark has given 21%. So I've done very well. So I said, very good. He was very happy. Suddenly, the other friend also came in. Now, when he came in, he was looking very sad. Right? Said, I'm not done well. I got only 44% return, and the benchmark has given 49%. Now, his fund was a small cap fund, right? The first person was a large cap fund, right? Now, suddenly the first guy who was happy suddenly became sad that Arey, how come you got 44%? I got only 27%. And the guy who was sad suddenly has become very happy that Arey, you got only 27%, I got 44% return, right? And during the entire conversation, I have not said a word up till now, and I am the one who's supposed to be assisting them in their investment journey, right? So the person who was happy became sad, and the guy who was sad became happy. So what I realized was that the only thing which changed was the emotion, and I had to actually tell them that first of all, it's 1 year. I have told you that your investment is for a longer duration. So I don't know why you are happy and sad. Secondly, I told you that you set a benchmark for yourself. I said, so since the friend who had invested in a large cap fund did not want to take that much risk, right? So I told him, keep an expectation of around 14 to 15%. And I said, you got 27, so you should be happy. The guy who had invested in small cap had a longer duration, and I told him, I told you that you should expect between 16 to 17% return. So I said, you should also be happy. So according to me, both of you should have been happy. But this is where I realize that everyone is trying to compare himself. Now they would have maybe, if they would have met somebody who would have invested in some another instrument, and if that would have given 100% return, both of them would have been sad, right? So this comparison trap is something which is a mistake which most of the investors make today.
So, extending this further, also in this social media age, we can say that we come across a lot of feeds through shorts or reels, which keep on telling us about different products and comparison with different products and how to create the wealth. So, even this at times is misleading. So,
Yeah,
can you
yeah,
address that as well?
it's a very very important question, and this is what we call it as the influencer risk. Okay, you can call it, or the influencer syndrome. I think it's not that everything what comes on social media is bad, but you need to understand that what is the caliber of the person. Is the person equipped to give out that advice, right? Because many what I've seen is that many influencers are basically trying to get sound bites for themselves. Hmm? And I think the more they get views based on that, they have a better rating and better chance and better earning or whatever, right? So I think one has to be very very careful. It's like we also come across a lot of investors come to us and they forward reels to us that what do you think about this. So half the time we are trying to even address those questions. It's very disturbing at times because a lot of misleading content is being then provided. I'll give you one example. One of the influencer is actually talking about that if a financial institution is buying this particular company, then why should you not be holding the stock? Okay. Now, you need to also understand that what are the circumstances under which the financial institution was holding the stock. It was quite possible that they had given a loan to that company, the company defaulted, and they converted into shares, or did they actually invest? So you have to take all this advice with a pinch of salt, right? Everybody is trying to sell their sound bite. So the best thing would be is that you look at the credentials of the person, understand what they are talking about, and at the end of it also, still you need to go and consult your financial advisor or your investment advisor or your chartered accountant or your broker who has better knowledge, where you are comfortable of giving your data to him, and he will understand what is your risk appetite. Otherwise this content can be extremely misleading, and I think most of the individuals will need to take it very very carefully out there.
So someone who is, every day going through such reels or shorts, so should should one completely switch off from all this, or should draw a line and decide what is to be taken and not?
No, so I always believe is that you should always look at things. So sometimes it also tells you what not to do, right? So it also gives a good indicator of what is to be avoided, right? So at times when you are in the investing journey, the more important is that what are the mistakes which are there, and if you avoid many of your mistakes, then I think you have won the major part of the battle, right? So sometimes, like they say in investing, by not doing anything is also a great thing.
Thank you, Juzer. That was really insightful. If we look back, the five mistakes were the incorrect mindset about income and wealth, impatience, chasing quick returns, comparing with others, and blindly following the influencers.
So yes, that is absolutely correct.
The message is simple. Most investors don't need more noise. They need more clarity, more discipline, and more patience. Income makes a living, but wealth creates freedom. Thank you all for watching. See you in the next episode.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully